All right, so somebody requested me to cover covered calls, explain how they work, how to make money on them, and what to look for. There's another strategy I wanted to go over as well, which is called the wheel strategy, um, which is selling a cash secured put. And then if you get filled on it, you then switch over to covered calls, you sell covered calls, right? For right now, we're just going to cover covered calls. Um, so basically, you need to own 100 shares of a security, right? Be it an ETF or a stock, whatever. So if it's Verizon, you need $4,000. 40 times 100. It's Apple. You need $18,000. Yeah, and obviously the stocks that are worth more are going to net you more in premium for the contracts than ones that cost less, right? And also volatility has a big factor in how inflated contracts are, etc. So we're just going to cover with Apple calls right here. Go to options. Yeah, exit out of this. Basically, you're going to be selling a call, right, of something that you own 100 shares of. So it's really a strategy for people who want to invest in something, but also make income alongside the growth of that stock, right? So sure, I could be bullish on Apple and think, next year it'll be worth $250. But if this week I don't think it's going to go to say 185, right? I could then sell this, and within 5 days I'll have $90, right? So you just click this, you switch it to sell. So you're selling the call. We're just going to sell one. If you own 1,000 shares, you could sell 10, but just one. So that's $90. 5 days passively, $90, right? Um, this could be a long-term strategy or a short-term, right? Because Apple's kind of slow moving. If I don't think it'll hit, 225 in 180 days, I could then sell a call 180 days out and earn income every single day until it expires, which is exactly what you want. You want theta to kill these contracts. Best case scenario is you want them to just expire worthless, right? You don't want them to move. You don't want the underlying security to move at all, because every day there's going to be time decay due to theta. Yeah, because again, you own the underlying security. So if the stock comes down, you're going to be losing money on it. If it goes up, then you're going to be making money on it, right? So this is what you're going to be netted immediately. You'll get $90 into your account, right? If it expires worthless, you get to keep all of it. Yeah. Um, but if you want to buy it back before it expires, maybe because you're scared that maybe it will pass 185, say we buy this back for $50, we get to keep the $40 uh, after we bought back for 50, right? Um, and again, since you do have to buy it back, if it goes past your strike price, if it's at 185 and it goes up, you could just leave it there and then you could let it exercise, right? Because 100 times, I mean, Apple's at what right now? 183. So 100 times two is $200, right? Which is more than this. So you could just, if this goes into the money, yeah, and let's say then it's worth $100 on expiration, you'll still make $100, right? Um, yeah, but you will have to buy it back. So if it's again worth, let's say since we're netted 90, it'll be worth, let's say $190, right? That means we'll have to pay $100 to buy it back and close out the contract if we don't want to sell our Apple contracts, right? This is something you want to do if you really do think it's going to run above and it's going to keep running, because then that week, if it goes from 183 to 200, it makes $700, right? And all you had to do is buy it back. So you'll take the $100 loss on the contracts, but you still have your underlying security. Um, Again, best case scenario is that this just expires worthless and it stays the same. You don't lose money on the stock and you make money from the contracts. Or if it just goes up to, let's say, 184.5, right? Uh, you'll then make $150 plus the 90 because this will expire worthless. That's best case scenario, obviously. That's why you want to buy it, a little farther out just to be safe. But obviously, you'll make less premium at that point. Uh, so yeah, let's see. What else can I talk about? What to look for. Obviously, here we are on Apple. Again, 185 would be a pretty good price because yeah, you have this high here, 185, maybe 180. This is 185.75. Maybe 186 is fine as well. The 1 minute, obviously, yeah, this 185 is that high up there. Yeah, 185. Yeah, so I mean, I'd say anywhere from 185 to 187 is currently safe with Apple. If you wanted to sell a contract, you're most likely going to end up making money due to decay through theta. Yeah. Um, yeah. So we just go back over here. You can look on this contract that's 5 days out, 185. It has a theta of $10, right? So every day you'll be earning $10 on these contracts. And obviously, since 5 times 10 doesn't equal, like we said, $90 over here, it's because the theta will go up the closer we get to expiration, right? All right, so yeah, that's pretty much it. Yeah, again, I want to go over the wheel strategy in the future because I think it's a better way to make money on this whole cover call thing and cash secure put thing. Like if I'm okay with buying Apple at 172.5 because I think, that's a fair price for it. It has a lot of upside potential. I buy a cash secure put, and if it doesn't get filled, then I make the premium. And if it does get filled, um, then I own the stock at 172.5, right? And I'm okay with that because, again, I think it has upside potential. Then I would just switch over and sell cover calls. I would make premium until it gets filled on that. And if it doesn't get filled on that, I just continue to make premium from it. So yeah, it's a pretty decent strategy to make passive income. Again, the more capital you have, the better. The easier it is to make money on this stuff. Um, but yeah, that covers cover calls. Trade safe, stay safe, and get ready for the week.